The massive artificial intelligence stock boom of 2023 and 2024 was fueled by more than just Silicon Valley innovation. Wall Street was scaling the rally using an interest rate arbitrage strategy sourced from overseas. In the financial world, this strategy is known as the yen carry trade. Following the collapse of Japan's asset bubble in the early 1990s, the nation entered a period of economic stagnation. To fight deflation and encourage borrowing, the Bank of Japan kept interest rates near zero. Seeking higher returns than government bonds, Wall Street institutions pushed this strategy to its limits. Hedge funds took billions in borrowed yen and deployed the capital into the highest growth sector available, the Magnificent Seven tech and AI stocks. The trade created a self-reinforcing feedback loop. As more yen-funded capital flowed into U.S. tech, the dollar strengthened while the yen weakened. This made the original yen debt cheaper to repay, further increasing the profitability of the carry trade. By early 2024, an estimated $1 trillion in global liquidity was tied to this single leverage strategy. The rapid appreciation of American tech valuations was being supported by a Japanese monetary policy originally designed to combat 1990s deflation. The landscape shifted on July 31, 2024. The Bank of Japan raised its benchmark interest rate to 0.25% and indicated that a sustained tightening cycle had begun. The currency market reacted immediately. The Japanese yen strengthened by 14% against the US dollar in less than a month. This move caught carry traders in a margin call trap. Because their debt was denominated in yen, the sudden spike in the currency's value meant their loans were now significantly more expensive to pay back. Many of these positions were highly leveraged. When the exchange rate turned, traders did not have the liquid cash on hand to cover the widening gap between their debt and their assets. This policy shift effectively turned a localized interest rate adjustment in Tokyo into a direct catalyst for a liquidation event in the American stock market. To manage the risk, automated systems triggered what is known as mechanical liquidation. Hedge funds were forced to sell their most liquid and profitable assets to raise the yen needed to cover their mounting debts. This resulted in a massive sell-off of the same U.S. tech and AI stocks that had benefited from the initial carry trade, including leaders like NVIDIA. A death spiral took hold. To repay loans, traders sold tech stocks for dollars and used those dollars to buy yen. This massive demand for yen pushed its value even higher, which in turn triggered more margin calls and more forced selling. As the system deleveraged, the entire global market realized the trade was unwinding, and institutions began liquidating their positions simultaneously. On August 5, 2024, the pressure reached its breaking point. In Tokyo, the Nikkei 225 index plummeted 12.4% in a single day, the largest point drop in its history. The contagion hit the U.S. immediately. The Nasdaq 100 fell 13% in less than a month, as tech stocks were sold off to fund the yen repatriation. A minor rate adjustment by a central bank half a world away had effectively erased $1 trillion in American market value. While the immediate panic across the global markets eventually subsided, the underlying mechanics of global borrowing had already undergone a massive, irreversible structural shift. By late 2025, the Bank of Japan had raised rates to 0.75